Hello everyone, welcome to our new video. We continue with our second chapter. Uh, First, we will talk about the financial institutions in this part. So remember, we were introducing the financial markets, and in these markets we have a variety of financial institutions. Uh, the banking industry is an important uh, type of financial that constitute the important financial institutions. We have investment banks and commercial banks in this category that constitute the banking sector. And investment banks traditionally help companies raise capital, and they have a few major roles. They design securities which are suitable for the investors, right? And they can offer these securities to the corporations. They can design, for example, new financial derivatives. They can offer forward products to their customers. And usually they have large corporations as their customers. And they can also buy these securities from the corporation, and they can resell them to other savers. So they can basically raise the needed capital, and they can fulfill the role of the underwriter. For example, if the company wants to issue some bond, the investment bank performs the underwriter role. So here, this is the keyword that we use, the term underwriter. So we also call these investment banks as the underwriters because they are the intermediary in this type of bond issuance. Or the corporation might want to do the initial public offering. Again, the investment banks can fulfill the role of the underwriter, and then they can handle this process of issuing the new shares or new bonds. So they have an important role in the functioning of the financial markets. As you see, especially they offer a lot of over-the-counter financial products. And in the recent years, actually, it's been in the last few decades, financial derivatives industry also grown significantly. And the role of investment banks is also in parallel to this growth. So investment banks offer a lot of financial derivatives, or they design new products for corporations, and they help them to hedge their risk using these new financial products. But of course, another, as we mentioned here, raising the capital for the corporations is a very important function for the investment banking industry. Next, for the commercial banks, of course, commercial banks are also traditionally in the center of the banking, and especially as you might know, some big commercial banks that are famous from the US market, such as Bank of America, Citibank, JP Morgan, Chase. So they are they also have the commercial banking, traditional, that's the department stores of finance, because they serve a variety of savers and borrowers. And historically, of course, the commercial banks were the major institutions that handled checking accounts and through which the Fed system expanded or contracted the money supply. So in other words, here you can see commercial banks are very important in the transmission mechanism of the money supply changes. For example, if the central bank purchases treasury bonds from these banks, from these commercial banks, then that is directly increasing the money supply, right? If the central bank purchases the bonds from these, Wells Fargo or JP Morgan, the central bank will pay, for example, the local currency to these banks, and that will translate into more credit in the banking industry. Therefore, the transmission mechanism of the monetary policy is achieved through the commercial banks. Okay, and whatever regulation is done in the banking industry, therefore, immediately affects the savers and investors and the credit, and therefore the real industry, the corporations are also immediately affected. For example, if the central bank raises the required reserve ratio for the commercial banks, that will be a contractionary move, because then the banks will need to keep a higher amount of cash capital at the Federal Reserve. Therefore, they will be contractionary in terms of their credit policy. So basically, as the main and most important role of the commercial banks is, in simple terms, to translate the savings into investments. That's the role for the commercial banks, their rationale for existence. So the savings will be deposited in the commercial banks. Yeah, right. I mean, you might have your savings. We all deposit our savings in commercial banks, and by using these savings deposits, commercial banks will give a higher amount of credit for many corporations in the economy, financing their investments or their other operations. Therefore, if there is a problem in the commercial banking industry, then the growth of the economy will be also in danger, because savings, if not translated into investments, then this will cause significant problems or even some financial crisis in the economy, because there should be investment, and therefore there will be growth and productivity increases in the economy. Without this investment, the growth of the economy will be stopped, and therefore the deposits that the banks will also have a difficult time to pay back the interest that they are offering for their customers. So essentially, as long as the economy grows at a reasonable rate, the corporations will continue to do new investments for future, and by doing these investments, they will generate the revenue that will also pay back the interest for the depositors in the banking industry. We will talk about the details of the banking industry a bit more later on, but this gives you a strong foundation. And there are also other financial services corporations that combine many different financial institutions within a single corporation. And most financial services corporations started in one area, but then they usually expand their operations and cover many diverse financial products and services.